Okay, welcome. I think it was in Latitude, Arvidas had the same entrance as you just now did, but it was planned. I don't know if you have anything.
Yeah, we have a saying that if you don't fall, you don't know how to stand up, so that's a good thing.
Yeah, that's true. It's also a way of grabbing a bit of attention, right? Yeah. Making a glamorous entry like that.
Exactly.
Thanks.
Yeah, I think it's actually many more people than I expected. It will be here, and it's good also to wake everyone up. So, welcome. How are you? All good?
Yeah, yep. Perfect.
Super. Okay. So yeah, I think there was a very good intro done that actually about the topic, and I think for everyone here, we had a call a week ago or so, and we said, okay, who knows who Zebra is? And I think like it's really interesting that we had to look it up because we did not really know what are the parameters of that. And I think this is maybe the cliche, everyone is looking after a unicorn, this is very clear. And for Zebra, I think I still don't know really what it is, but we'll try to untangle it. And then there are probably attached words like burnouts, fast growth, etc., that we will be looking into. But then we have 3 VCs on stage, so yeah, we'll figure out if it's actually, if we can go after Zebra status, not unicorn, if we want to return our funds. So maybe we'll break it down a little bit. We'll talk very shortly about your fund, but not from a way of what you're doing, what good investments you have made. But I would be very interested to hear, if it's not confidential, obviously, the size of the fund, the return you're promising investors, and maybe how many unicorns you have calculated in your model when fundraising. So maybe, Peter, let's start from you.
Yeah, sure thing. So I'm a part of Launch Hub Ventures, Sofia, Bulgaria-based fund. I can say we're like a typical seed stage venture capital fund investing across Central and Eastern Europe. The current fund size is 75 million. We're investing out of our fund 3. And we're in a preparation for our next fundraising. So basically, we're using the rule of thumb in terms of promised returns to our investors, which is 3x. And the number of unicorns that we calculated in our model is in between 1 and 3, depending on how you define unicorn, because the unicorn can be a $1 billion company, it could be $10 billion company, and the outcome it's super different in those ranges. So this is what we do, yeah?
Super. Arvidas, do you have different number of unicorns?
No. So like, yeah, we're a practical capital Baltic investor, largest seed fund from Baltics to Baltics. Currently 80 million euro, launched last year. And yeah, our kind of models in 5 companies, roughly like 15% hit rate to 5 companies, that is 300 million euro outcomes, right? So we say whenever if we catch a unicorn, this mythical being, right, we are like super lucky. So we are investing into cockroaches, not unicorns. So, you know, the companies that can survive, you cut the head off, they live for another 2 years, they can live in space, you know, in cosmos, without air. So that's what we're looking for, and we are pretty successful in that, yeah.
We should add a third, like unicorns, zebras, cockroaches, and maybe something else.
I haven't found zebra yet, but like
yeah.
maybe.
Maybe, yeah. And how big is the fund?
80 million euro, yeah.
80 million. Okay.
Also third fund.
Okay. Yeah, Michael?
I like that, cockroaches. I didn't hear that before, but that's super important.
Only in the
also,
Baltics, only in the Baltics.
On the topic of resilience, founder resilience, it's a good time to say that. So I'm from Rockstart, which is a Dutch incorporated fund, active in investing all across Europe. We have 3 different pre-seed funds, so in various domain themes, all responsible investing as an Article 8 fund. So we have 1 fund in agri-food, 1 fund in energy, and then the fund that I manage, which is in emerging technologies. And they are between 25 to 30 million euro funds. So it's real pre-seed investing, super early stage. Almost nothing is too early for us, provided that the team is the right one. That also means, because we're such a small fund, we don't actually believe we will find unicorns. It's great if we do, but much less will also be able to make a fund return. And we target a 3.5x return on the fund.
And do you capture any unicorn status, or more like Arvidas said, 300 million something?
The largest company we exited so far was sold at 350 million.
Okay.
So
yeah.
1/3 of a unicorn, but that's still a pretty good fund return if you enter that company at a 2 million euro valuation.
Yeah, from early stage for sure. So we are also with FIRSTPICK at the stage that you are, and I understand your pain, so I think it's a good time to switch a little bit. Maybe we'll start then from you. You are the one who sees the entrepreneurs most early on. They come to you, they have a lot of energy in their eyes, and then you say you always look into the team mostly, how much you're looking for this ambition, grit, like all the words that were also mentioned before on the stage, fast execution, or actually you prefer then to look into something more zebra approach, how sustainable, long-term focus the founders are.
So looking at execution power is extremely difficult if founders have only just gotten started doing what they're doing. So what we look at is how did these people get together? Why are they actually together as those people, 2 or 3, 4-person team? And what have they done in the past? So is there something in their history that indicates that they might enjoy the turbulence and the throwing themselves into the unknown and dealing with that? That's more what we look for, not necessarily what have you been able to execute and what you built, because maybe you're a first-time founder, but then you have done something different in your life, which perhaps shows, that you're a good fit for what you're about to get yourself involved in.
How often do you evaluate ambition as a factor?
Oh, ambition is great, but isn't it so in all parts of life, really? And again, how do you measure it? You could have actually been able to show ambition in another field. Maybe you're doing elite sports, or you're extremely creative in music or arts, something else. That's also ambition, I believe.
Yeah, I agree. Arvydas, you see companies a bit later. How do you deal with the founders' appetite for growth? Is it usually, do you see it's too little, too much? How do you manage it?
We don't handle it at all, right? So, you have a conversation, and then I try to understand, like there's a saying, the best time to plant a tree was 20 years ago, or second best time is now. So you look at the person and try to understand, did he plant a seed 20 years ago? Like, is he ready? Like, is it like really investment? Or is it that you have to nurture and go through the motion with a person? So this ambition is like, it's like a concept, a word, but like, is it like a fairy tale imagination, right? And then you create certain expectations, and that's why the burnout and so on, because you have, you have ambition, but you don't have ammunition. So like you're very ambitious, but you don't know what to do. Like you don't know how to hire. You're typically doing too much, like taking too much responsibilities. You cannot delegate, and so on and so on. So this is what you try to assess at the very early stage of investment, or at the initial investment, next to all the numbers, KPIs, and all the other stuff, right? And then you go through the motion. So I think the only control as investor you have is when you make a decision to invest. Afterwards, you're in the same boat and you're rowing. And when you're rowing, it's not like who is rowing, right? All should be rowing. So I think in that kind of mentality, concept, we try to operate very simply, because let's not go into all these definitions and details, but that's how we think very roughly.
So Peter, do you see more, you have to sustain founders model where they say we'll grow 5x every year, or it's actually usually too little? Like they say 1x, 2x.
Well, basically, we believe that it's very hard to build proper returns to your investors without actually having an outlier company. Whether it's going to be a unicorn or not a unicorn, reaching this 1 billion status, etc. It doesn't matter, but you need to have one or a couple of outlier companies. So in order to get to this stage, the companies needs to grow, right? So that's given. So whether we are pushing the companies to grow from day one, 5x year over year for, not really. I mean, it really depends on what's the stage of the company, how much time they need to put in developing the product. Once they start scaling, what are the leading indicators of the growth? And we are trying to adjust and to see, what's the environment, how the company is growing, what are the leading indicators. And after that, trying to, help founders navigate this environment with the mind that the companies need to grow, right? So that's why those type of companies are called startups, because, I mean, the growth needs to be there. Yeah.
Yeah, but how relevant are those, I don't know, keywords, double up, triple up, or 20% month-over-month growth? Is it something founders should be ready to actually handle, or it's more of a, I don't know, the narrative in the market, but no one is really following?
Well, I still believe that this is still relevant, even after the kind of a slowdown of the economy right now, the slowing down of the overall industry, and yeah, I think that should be the thing after one moment of the life of the company. Basically. Yeah.
Okay, so that's almost an answer that. Yeah, I don't think Zebra has this feature, so that's almost an answer. But we'll see about that. But yeah, I think going a little bit, when you invest in the companies, and then there is a certain amount of money there, and then you have the runway. And I think especially in this environment, it's a very popular topic. Everyone to extend the runway to like maybe 1.5 years, 2 years, but then you might be sacrificing some growth initially. Did that change actually from, I don't know, back 2002, or that's just the narrative and it's actually nothing has changed with like good investors as you are, so.
Yeah, I think the way people talk about it changes a lot. It gives an excuse for investors to say, we would actually like you to be closer to profitability. But in reality, I actually think that most VC investors would sacrifice profitability for the right element of growth. Also knowing that if you kind of put your company almost to sleep and not spend money, and you have low growth but close to profitability, at some point in time you're going to pick it up. And if a venture investor is going to go into that takes some time to bring the pace back up. So yeah, I think it's a convenient saying, but also sometimes, especially for angels, which is very much what we meet in this pre-seed stage, they like to say, yeah, profitability, but is that really what you want to invest in? I don't think so, to be honest.
Andreas, what do you think? Does it help being profitable, break even or profitable? Does it help the company fundraise or not necessarily?
Probably not relevant. Like profitable or not, it's like what is relevant is that nothing changed. Like fundamentally, nothing changed. You're like we're not like startups or VC is not somehow excluded from the economy. We like when you invest, or what's the expectation that future cash flow it will be somewhat valuable later, and what has changed the cost of capital. So the discount rate has changed. That's why it's like it's different cost of capital required to develop this, and there are many alternatives where to deploy the capital for LPs, right? Like the debt products could yield 11-12%, right? An average VC return is 15%, like including all the best funds and so on, and that is very good return, right? So like this has changed, and then it's like we talk about startups, but it's an outcome, like the recalibration happened. So yeah, you look at the startup and try to understand being profitable or cash neutral or like grow, like sustain growth. It is very critical to adjust to this reality, right? It's not like VCs are bad, like they're not giving money. It's like we are a function, like we are capital allocators. So like as a startup, you have to first of all be aware like what is happening, right? It's not like this guy is good or this guy is bad. It's like you're allocating capital and you have also like opportunities, and you try to understand where to push the company and what to do. And where to push the company, it's uncertain times. It's better to grow sustainably. And that sustainably grow is like, are you ready to really spend on marketing? Do you really need to raise so much money, right? Are you ready to raise and dilute yourself? Like, look, what's the end goal of a founder? Like you get round, dilute, and you unicorn with 5%. Congratulations, amazing, dude. Like 12 years of your life and you're 5% owner. But if you had taken less capital, right, and had better management, maybe it'd be like 12% owner or 30. So it's not like a rigged game, but like you have to be aware and understand what is happening. So that is like a short form answer.
And that's the same today as it was 2 years ago, right? It's the same. So even if the circumstances, the market conditions have changed, that story still very much holds true. Venture capital isn't going to save the world. We're there. We'll offer it for the right business, and if you like it, but you shouldn't have to feel, you have to take it.
Yeah. So you might say that it's usually founders who are actually pushing more, like optimizing for fundraising and optimizing for maybe the cap table, but not in a good sense, so seed, Series A, later rounds, or it's the VCs?
What I can say here is that basically making startups is very competitive type of exercise. So making like a large company and really a leader in a certain category and so on and so forth. You know, when you're a founder, you have like 10 companies that are behind you or around you that are competing with you. So if you want to really make it big, you know, you need to invest early in growth, in product development, go to market, all of those things to get market share so that you can be really the leader of the market. And the most ambitious founders go in that way, and they prefer to raise money so that they can fuel the growth, the development, and so on and so forth. So I don't think that VCs are pushing really founders to raise money. It's driven by the founder and by the ambition of the founder, basically. But yeah.
But I do think VCs will try and pry their way into a great, appealing business, say, hey, I want a piece of this growth. Probably because you think you can help it, but also because you're seeing it as a good business, right? So we're not saints. We're also salespeople trying to get a piece of a good business, right?
Yeah, exactly. And you, as a startup, you understand. Once I invest, next minute I start to sell you. This is it, right? This is what happens.
Yeah. Yeah, but how many times do you think you've actually told the founder raise less than what they wanted? Has that happened? Or for lower valuation?
Yeah, it's like not what you, no, it's like not raise as much as you need and build a conviction in how much you need and why. This is like why you spend so much time, you know, building. And this is not in pre-seed stage, it's a bit later, right? You have to really understand where to deploy the capital. And we have like this confidence level that we look with practical, like how confident are you, like what's the confidence score of revenues, right? It's very low. What's the confidence score and burn rate? How we can backload the costs, so not to hire upfront, but scale the organization once we're at capacity, hire, put a process in place for. So this is more like how you approach it. And then raising is just like exactly as you need. And if you don't need, because look, VCs, like if it's a good company, and we had like in our portfolio when, you know, US fund comes and I will give you 50 million. It's like not, if they don't even look at the model, it's like 50 million. We need 20. And then of course you would take 50, you get diluted more. And it's good to have money, but they're just sitting in your account. Maybe this time around it's a good thing, right? But like it's not. So you raise as much as you need, like exactly same amount what you need.
But that's exactly the question. So is it investor who points that to the founder? Like the founder could get super excited, like 50 mil. Why not?
Yeah. So this is a stupid founder, but you know, if he has this conversation, it's like, you know, if you have an investor that wants to invest and there's like, you can have a conversation and you can push it down. It's like, investor wants to invest 50 million, I must accept him. No, you should not. Like if an investor is looking at you, are you like a businessman? And do you understand, do you own your business? And if not, yeah, I'm gonna take whatever money is thrown at me and it's gonna, you know, dilute myself and so on. It's a happy ride. Good luck.
Yeah, I think there was this scene in this TV series Silicon Valley where the guy accepted, I don't know, like a super big check, and then he was like, "Oh, why didn't anyone tell I don't have to accept it?" Actually, so I think it's too realistic. It's actually happening that way. So okay, so that's clear. I think the second point of the zebra thing. So what I'm coming in my head to understand is that obviously growth is important, but you cannot optimize for just having the best round. But yeah, I think those double up, triple up, they are necessary. Is that then such growth for every business or for every founder? So if you want to be a zebra, maybe venture capital is not for you. How often, Michael, do you identify that early on and you say like, no, you shouldn't even take it?
Yeah, there are plenty of companies, startups, and founders that should not take venture capital, but that still pursue that route, try it out. Maybe they don't know what they're getting themselves into. So I would say many companies will be great companies, but not because of venture capital. Some of those, yeah, you could categorize to the understanding we try to establish around what is a zebra company. That would in itself probably be a paradox if a zebra company took in venture capital, to my understanding of it. But there are also companies that are just not scalable to the extent that it makes sense to take in venture capital, where a more patient angel investor or family office, or even just, of course, ideally self-financed with customers, slow growth, and you can build a great business.
So if you invested, I don't know, 2 million pre-money and the exit is at 6 million, someone bought the company, is that a failure or success?
I think it would be a failure for me as an asset allocator, capital allocator from a venture fund. Could be great for the founders and for others. But for me, of course, I rely on making a lot higher returns on my investments. But there will be, and already are in the portfolio of the fund I manage, companies that mirror more that path. So then, yeah, I made a mistake. I placed a bet. That's what we do.
So then it's good for founders, not so good for the funds, right?
Yeah, but that's fine. That's why you do diversification across the portfolio, and you know that some will go well and a lot won't. Unfortunately, they will run out of money and fold. And then some will actually build like a, what they call lifestyle business or a small medium enterprise, which can be fine. That's okay. I think that's wonderful for those founders, and I can live with that, sure.
Any characteristics of the businesses you would say, Peter Arvidas, that shouldn't raise from VCs?
Well, there are a lot of businesses that shouldn't raise from VCs, like service-based businesses, more of a lifestyle type of businesses. You know, those type. They don't have to raise money from VC. You need to companies that needs to raise money from VCs are the ones that have the potential to scale to really big markets and really big volumes of customers and so on and so forth. That needs high investment in terms of R&D, product development, and all of those things. So all of the rest, there are different financial options to finance the business. But yeah, this is what I would say. Mm-hmm.
Yeah, agree. So, you know, as a founder, you should celebrate every day you're not giving away your equity, and you know, and just every day open champagne, and yeah, I have 100% of my company. And then you should be very careful, you know, why you raise and from who you raise, and you understand that VCs exist for one reason only, right? It's just like we exist to allocate capital where banks cannot give you a loan because you have none, right? That's it, right? And then the hit rate, even us as professional managers, right? The statistics of, like, the European Investment Fund across their investments in Europe, 5% of portfolio in a venture capital fund return more than 10x, right? So and probably 60% is write-offs, so it's not successful, right? And then some are like 3 to 5x. So actually, it's like it's a nasty business we're in, right? So you have to allocate in very outlier outcomes. You have to. We are not investing for 3x return. We're investing for 100x return in a single company, the potential for 100x return, and then you apply the statistics, you get you know, with 10x on average on one good investment. So when you come in as a founder, you have to understand your partner. Your partner is probably probability weighted outcomes. You look at this 150, 200x potential at seed investment, right? So if you're like, you know, service business and you want to grow 20% per year, okay, you can still grow 20% per year and get VC investment by building like a product sustainably and you know, preparing for like supply balancing on the marketplace side or so on. So this is like the long form answer, yeah.
Yeah, I think this is also what we try to explain of why founders usually ask is like, why do you ask about this ambition or total addressable market size, and why is this unicorn cliche? But this is exactly that, because usually you are really betting on one or two outliers, even in the pre-seed funds or in the seed funds or later stage ones, and you calculate that, but every investment should have this potential. So I think that's very important for the founders as well to understand like the partner who sits in front and why they are thinking or why they are asking the questions they are asking. So not that businesses that grow 20% month over month or like, I don't know, double a year is bad. And I think that's very important to distinguish that. But then going a little bit into another aspect of zebras is the sustainability, which can probably be interpreted in many ways, but I think it's not so much about the ESG, let's say, impact or anything like that, but it's just slow, sustainable growth that can be sustained over very long periods of time, not like 5 years immense growth. But how relevant is that to you when you're looking in the startup? How do you measure this pacing of growth and aspects of sustainability in your selection?
At the stage we invest, you maybe have a couple of pilot customers, some early revenue, so there's not an ability to measure what has happened so far and the pace of that growth. But back to what Arvidas is saying, we all have to look for the possibility for proper growth for a number of years for the investment to make sense and pay itself back. So that can be sustainable in itself if you talk about growth being sustainable. They only raise money once, and then they keep a high pace, but they just get lots of money in from revenue, maybe prepaid SaaS contracts, whichever. That's sustainable growth, isn't it? So yeah, but anyways, it's not really an assessment criteria at that stage. It would be for follow-on investing for us down the line in rounds 2 or 3 that after we invest, but not when we look at them initially.
But what about the actual sustainability factors? Because they do seem to play in the description of Zebra.
Yeah, well, as Article 8 funds, and actually some of our funds could be Article 9, but it's just a big mess to try and report on that, and you enforce it on the portfolio companies. Yeah. But anyway, that's responsible investing. So we have a lot of screening criteria in terms of the positive impact that those companies intend to deliver, which is another part that precedes. It's your desire to build a company that has a sustainable angle, but you have no proof for it because you're just getting started. So this is based on belief, not so much on results yet.
Yeah, I think if we push that on our founders, a lot of sustainability ESG reporting and basing the growth, we might be losing to other regions like US. What do you think? Oh, the question is if we are actually putting on the sustainability factors as something we want to measure, something we follow on our companies, and pacing the growth, isn't that pushing our region behind US, for example?
Maybe I'll twist the question to my
to your answer
and beat everyone with my experience. Yeah, but probably the thing is that cost of capital that we are given as a managers, right? It comes with certain attachments, right? Right now, big allocators, pension funds, so on, they have they are like if you have a lot of capital, right? You can choose where to deploy, and I think this is not necessarily, or right now, it's not only driven by financial return, right? So you can get like the best IRR on the fund, but be an asshole, right? That is like has many things done bad and like unethical, and you will not get any more capital, right? So I think you have to realize that it comes to us as GPs also with not only the capital but some wish like and also like expectation from our LPs. So that is one thing, right? And then you try to channel it down to your portfolio companies. And I think it's especially in our region, like in Bulgaria, probably Baltic states, we are developing to that notion. In Western Europe or US, it's much more developed countries. So for us, it's like get very fast to average EU level, and we're super hungry. Look at what's happening, investments per capita, so on in Baltics. It's like we are hungry to live good, and it was not on our agenda. We had to catch up very fast. We just build. And that's been super successful journey, right? Right now, I think it's slowly becoming this transformational moment for many. And we are also like at Practica, we try to just do simple things. We have questionnaires, we measure, we try to like push the company in some, like some procedural, and we just include one slide on the board, and every board deck is like ESG. What did you do? Did you do your best? So I think it's just like small things that accumulate step by step every quarter. It's not going to happen all at once, but step by step, just to have it on agenda, to really measure, to understand if we do we do due diligence of our suppliers and so on, in terms of do we really know that they are ethical, and so that's like simple things that add up to greatness towards 5 or 6 years investment period. So that's like how I think.
Yeah, also we believe that in early stage, in terms of from the perspective of ESG sustainability, you know, it's not that relevant when you have 4 people in a room working on their pre-product startup whatsoever. Those things starts to become important after Series A, for example, after you scale to 30, 50, 60 people team and so on and so forth, then those things start to become more and more important. And another thing I would like to mention is that basically we don't believe that growth is related to sustainability and ESG. I mean, you can be super ESG compliant and to be super aligned with all of the ESG regulations and so on and so forth, and still to achieve amazing growth and to develop the company into the right direction. Those two things I don't believe are super related and aligned. So whether we push our companies to be more ESG compliant, yes, we do, but with being mindful of, you know, what's the stage of the company and what's in front of the company, and what's the most important thing. Because you can invest in the best ESG compliant company, but this company can fail in 2 months, right? So still, we are mindful of that we're investing in companies that needs to become big. And
I think that maybe that's the good side of the coin of regulation and ESG trends, that it drives performance in companies that think about this and actually provide something sustainable. Because people out here, customers, consumers, founders, they want to build something with a positive impact. Regulators are saying that you have to do it. Investors in funds also sometimes require, well, this is what you have to do. The flip side of it and the bad side of it is that I do think you're right, that if you're the good student in class who is doing everything according to the book and very complicated regulations that you enforce upon early stage startups, you quash innovation and you might be at a disadvantage to, for example, other regions, including perhaps US, who do not have the same requirements. But I mean, we got to do something about innovating to solve a lot of the issues out there, right?
Yeah, but I think it's a very good point that Arvidas mentioned, that you have kind of fiduciary duty to your LPs, and some LPs are institutional and they come with the requirements, and otherwise you would not get the money, but at the same time it makes a lot of sense if you want to enforce something on a larger scale. But at the same time, then you have probably a bunch of private LPs who are expecting this, high growth. They don't care so much about, whether you fill in the questionnaire or not. They're super interested in technology. Do you think it would be possible to raise a fund, I don't know, like yours, for example, that when you would come and say, we are investing in slow growth, sustainable companies over a long period of time, looking for profit, maybe no unicorns, not even maybe 1/3 unicorn, just hypothetically. Would that be much harder or almost impossible?
I don't think that thesis will sell to the majority of investors. Then you're like almost a philanthropical fund.
There are funds that even the EIF invest in this social benefits, that they don't look for return. They look for like improving well-being of society, right? And they just give you money to invest in this social innovation, social impact. Right, and they exist actually, these funds that kind of, but they not necessarily like they lead the rounds. They sometimes invest also like in co-invest with other funds because they believe next to economical benefit, they are doing some progress, social progress for the society, especially when with developing regions. So I think it has a right to exist. It exists, but as a manager, you choose what you want to do. Could I invest like €1 million in a startup that's growing 10% per year? And I can invest actually whole fund tomorrow if I want. Right? So many pipeline here, bam, that's it. My job is done. But like, okay, and then what? So if you have expectation for return, right? You're always competing. Like capital it's in a way central banks print a lot of money, but it's finite, right? So you have and you need to allocate it. So it's what you do. You're always in competition. €1, $1, in debt, in alternative assets, like in crypto, whatever you expect a return. And this is like not a fairy tale. Like it's just capital. It's a rule of the game. So I think, I would not, if I would invest in these like slow growth startups, I have a strategy. And then I have to have LPs that look, and I have to report somehow the benefit because I take money from economy and put it somewhere else. So this money has to do some good in that sense.
Yeah, I agree. I think we have free venture capital funds, probably some more like altruistic public maybe body should be also on stage because there should be diversity. I think all of the funds in general, venture capital funds, they come with this mission. And I think it's a good point that you come with a promise, you come with a strategy to multiply the capital, but there are so many other alternative things. So coming to an end, I think, like thinking still of unicorn and zebras, to me it sounds like unicorn is the way to go. Zebra is something that maybe we have not like really still seen so much in venture capital world. Maybe cockroach is also a way to go, which could be. But maybe some last remarks from your side, maybe starting from you, Peter. So did you understand at the end who zebra is, and is it unicorn or zebra?
Yeah, I understood what zebra is. I believe that there is a space in our world for zebras and unicorns. Just you as a founder need to understand, you need to pick up what path you're seeing yourself and the company going, whether it's you're chasing the unicorn type of road forward, or you want to make a zebra, and to decide what kind of financing you want to need for that and what money you want to raise, so that all of the parties be aligned for the path of the company going forward. So that's it. Super simple. I mean.
Super simple.
Yeah, so it's like again, I think it's irrelevant, right? So you look in the mirror in the morning and like, oh yeah, I'm a zebra today, or a unicorn, like or a cockroach. I would like to have more cockroaches, right? But it's like, so you just do your things, and one day you're a unicorn, you're like 300 million out. But every day you just do your best, right? And I think this is the whole point. And if environment changes, if capital allocation changes, if the market changes. Right now, discretionary income is down because of interest payment, right, for mortgages. Like consumers don't have that much money. Consumer businesses are suffering. So it's like you be aware of it and you adapt. It's not like I will be zebra now and I change my strategy because I'm zebra. No, it's like you change your strategy because market changed, right? And you're just being aware of what is happening, and you make a decision as an owner of a business. It's not like some magical venture capital world where money is being sprinkled on you, and you live and do your decisions because the capital is available. No. So I think given that fundamentals, you're in control of your destiny. And when we talk with founders, the only expectation I have to the founder after investment, are you doing your best? This is it. He doesn't own or she doesn't own us anything. We made the decision ourselves. It's not like, I will suffer, I will battle, I will return your money. Come on, it's not why I invested. Do your best.
I think Peter also said something interesting, that there's no conflict in building a good, profitable, attractive business in a sustainable way. It can even become a unicorn, because a unicorn, I guess, technically is just saying it's $1 billion worth. But that doesn't mean that you need to take venture capital or go through a certain growth phase. So if you're a founder out there or anywhere thinking about building a company, yeah, choose your path, know why you're doing what you're doing, see what the market says, see what your employees say, what kind of culture do you want to build, what kind of people do you want to lead and attract to the company, and is that a democratized ownership structure, non-profit organization, slow growth, fast growth, venture capital or not? Yeah. Make it your own story, I guess.
Super. Yeah, I think very good thoughts. Be the best version of yourself. Drink champagne every day, celebrate cap table or something. No, but I think it's really good closing remarks. For me, it's definitely much more clear. I agree completely that you can choose whom to be, but at the end of the day, labeling is not something why you're here for in this conference. So definitely there are a lot of different ways to go, and I thank you all. So it was really interesting, and yeah, let's go. Thank you.
Thank you.